We're going to talk about IPPs primarily today. For 12 years, I ran across the country for an outfit called GBL, or Gordon B. Lang and Associates. We did and still have set up the most IPPs of any firm in the country, at about 2,200 of them. And the fun thing is that though they were competitors, most of my competitors became friends. So I talk regularly to Mark Lesniewski from LMC or Stephen Cheng from West Coast and some of the guys at Buck, and in my bastardized grade 10 French, I even carry on conversations in Le Belle Provence. Since leaving, I'm a self-styled tax mercenary, so I don't do corporate well. Compliance departments and human resources departments have, room-sized files on me. So hence I tend to hide at home and occasionally venture out to write a tax memo. My forte is really owner-managed tax planning, doing a lot of insurance. I'm licensed in 7 provinces, including Quebec, and specialize in leveraged insurance, hybrid pipelines, insurance shares. My standard joke is I'm a former stockbroker and I'm a lawyer, so that when I'm dead, I'll be buried face down, so I know exactly where I'm going. I will try not to offend more than half of the room. Paul has electrodes attached to parts of me, so if I get blatantly political, I may jump. Suffice to say, the current Prime Minister is not a fan of mine. Those of you who follow me on LinkedIn, I have about 7,000 followers. Probably noticed I had a 9-month hiatus in the LinkedIn penalty box because I might have referred to our dear Prime Minister in less than flattering terms, but that's the way things work. So here we go. We're going to talk a little bit about the tax landscape. I mean, this has been done to death, but we'll cover it off and why retirement is critical. I'm going to drill down mostly on IPPs today. If you have questions, I mean, we've got Q&A at the end. If you've got questions as they pop up, just ask away and we'll deal with them that way. I'm going to spend a couple of minutes on RCAs. In fact, I do more RCAs now than I do IPPs. And in a sense, I refer them out. I consult on all this stuff still, but I don't write the paper. Occasionally, I will put my lawyer's hat on and do an RCA. But I tend to use the RCA more than the IPP these days, although the IPP is making a bit of a comeback. Permanent insurance as a retirement plan. This is Freedom 55, as they called it in 1981. Still works. In many cases works better than an IPP, but it's really client-focused tax. It's based on their particular tax situation. And then if we haven't had questions throughout, we'll do Q&A then. So how would I describe the tax environment in Canada right now? It's punitive. I always tell people they know what they're doing. The Liberals understand tax. I don't agree with virtually anything that they have done, but they do know how to affect change. When Gordon and when I was at GBL, our biggest seller in the last 5 years I was there was not IPPs. It was market valuations of life insurance policies, where you would roll them into your corporation and strip out free money. And I used to tell Fraser and Brian and my sales guys, I'm just going to put sandwich boards on you and march you down Bay Street. And that's all the marketing we ever had to do. And I warned Gordon, I said, look, they're not idiots. This is not the NDP winning a fluke election. They know what to do. And they did. They shut it down very well. And they've been very precise in certain areas as to what they want to do. They have thrown a ton of money at CRA. So phone calls are starting up again as the collection forces marshal to come after people. I used to, surprise, raise money for Stephen Harper. And I remember telling him one time, I could call him Stephen then because he wasn't the PM yet. I said, do you know that there are more auditors in CRA than Canada has infantry? And he goes, you're kidding me. And he goes, it's absolutely true. And it's several times more. So the environment is not good for the taxpayer. We know the evidential burden hasn't changed. The argument that they make that the taxpayer knows their own situation is absolute poppycock. The Americans have adopted a somewhat changed evidential burden. There's no reason in the world of the Compass algorithm and, what is in essence electronic surveillance that they can't know exactly what you're doing. And that, in my humble opinion, the taxpayer should be innocent until proven otherwise. But I think that's going to take a change of government to bring that about. And I assure you that's not high on their priority list. There are other fish to fry. Retirement planning is particularly difficult because it's just a question of can people keep their own money. Contribution levels for all plans, including RSPs, are low. There's only about 15,000 IPPs. When I left GBL, there were 12 to 13,000. So I talked to my competitors who are friends, and they tell me how many plans they do a year, and I can extrapolate. And there's probably about 15,000. So Peter Merrick and I, years ago, when I was helping him write his book, he thought there would be 100,000 IPPs in short order. There's not. There never will be. Attempts to mass market this never work, because every case is its own case. Most of the folks, even the accountants, when they're involved with IPPs, don't have a lot of familiarity with them. I understand some of the CPA training is like 2 hours. I've seen the materials to be, a blatant, because one thing with COVID is my filter was quickly destroyed. The materials are wrong. The stuff that's in CFP is wrong. Jimmy Kraft wrote it. He's a friend of mine. He's supposed to fix it. But we'll tackle that today. The SBD grind rules, going after the ability to shelter and defer in a corporation, we all know that's not a nice thing. TOSI is a Byzantine mess. I still don't understand it, though I read on it all the time. Tax rates are just too high. And this couple of quotes. He's not a close friend, but I consider Conrad Black to be a friend. I had him speak pre-COVID. And he said to our assembled mass, which is about 120, that anytime that the state, well, he said, short of war, there's no moral justification for the state to take more than half of what one earns. I mean, you hear stories in Nova Scotia about how they have 10,000 people waiting for doctors. They're lovely people. It's a lovely countryside, but 54% and tax rates and half a year of winter will drive lots of doctors south of the border, and that's what's going on there. And here, by the way. There is a very active consulting market in pre-departure planning, of which yours truly, I'm in that. We do all kinds of specialized insurance, domestic and non-domestic planning that will affect lovely results. Because people, I'll tell you, are fed up. The tens of billions of dollars that have run out of the country, they're not coming back.
What's the difference? Because we hear all kinds of differences between Canada and U.S. and I know it depends on
what state you go to. So the basic thing is, I mean, California has as high a tax rate as we do, but it doesn't kick in till $400 and something thousand. So the bracket is huge. I mean, if you go to Florida, I mean, they've raised federal rates. I think it's 38. But if you have, your joint filing, all that kind of stuff, you're almost $500,000 before you hit it. So there's a substantial gap. Yes.
Don't forget to add back healthcare costs.
Healthcare costs. I mean, if you're making $500,000, for the most part, you can cover your own healthcare. But you're right, it is true. But Canadians live under this myth that we have free healthcare.
But that healthcare cost, what I understand, if you're working for a large company, it might only be $10,000 a year. It's not $10,000 a month. Am I right or wrong?
Exactly. There are certain elements that are really hit. My wife's her family's from Wisconsin. And her aunt and uncle are organic beef farmers in southeast Minnesota. They're the nicest people on the planet. And they tell us about what it costs. So the Obamacare thing helped them to some extent. It's funny because every time we go visit, we stop at this giant liquor barn in La Crosse because we're wine drinkers. We fill up and we're crossing the Mississippi. And every time Lindsay gives me the speech, she goes, "You're not allowed to talk about politics. You can talk about baseball, football, and the stock market." I said, "Our daughter's name is Reagan. I think they know." So, and my other line is, of course, is Winston Churchill talking about tax, because Churchill is a lifelong hero of mine. Wealth tax is a very real possibility, particularly if our dear friends in the NDP continue to hold the balance of power. Can we evade it or avoid it? Sure. But the tax on profits in insurance companies and banks, that's the test for this thing, by the way. And the Parliamentary Budget Office has already told them that they can probably ramp up $60 billion. They'll spend 120. But it is a very real fear. That's why a lot of my departure clients have come to me, saying if that's what's going to go on, we're not staying. What else? Principal residence. You hear this floating. I don't think, again, the Liberals are not idiots. That would be a political third rail. But what you could see them doing, particularly because they like to couch everything in terms of class envy, you could see them come out and say only the rich, only the 1%, which, by the way, in Canada is $184,000 a year, they have, they're not paying their fair share. So what you could see them do is say, okay, we'll exempt everything under 750, everything under $1 million. They would probably never come in with a full capital gains tax, but a modified special tax. Because they're insidious. I mean, this is what they do. Capital gains
I talked to a senior Liberal, and they say they'll never touch this because they'll never win. They'll never win the next election.
Well, let's hope. I'm not allowed to run, by the way.
I like to just create the comment.
No, it's true. I have surprisingly friends who are liberals, and they talk to me. And I'm shocked because I'm a Canadian history nut. Or I'm a history nut. And I've had, I really like Jean Chrétien. There's a great, Lawrence Martin's 2-volume biography on him is fantastic. I mean, Canadian history is usually dull, right? It's excellent written political history. Really, and I like him because he's basically self-made. Admittedly, the Desmarais helped a little bit, but he's got a great story. And there's an excellent book by Bob Plamondon called The Shawinigan Fox, where he argues decisively that Chrétien was our most conservative prime minister ever, and that it was he that slayed the deficit. It wasn't Martin. It's really worth reading. His book on Trudeau Sr. is excellent because, according to Inside, John Turner was the source for all of the stuff, and Mr. Turner and Mr. Trudeau did not like each other. So there's some stuff worth reading. Capital gains inclusion rate, every year in the accounting community, we rush to do capital gains strips because we figure that this is the year it's going up. Who knows? I mean, it's certainly in the playbook. I don't know. I mean, my own sense is there's an election coming sooner than later, that the grandees in the Liberal Party know they're going to get their ass kicked. They're at their best before date. They'll go into exile for a few years. They're not going to run Carney in this election. That's their prize horse. They'll wait. That's just my 2 cents on it. We can talk politics all day if you want. So individual pension plans. So these things have been around since '91. They were the first time that a business owner, connected person shareholder could actually be in the company pension plan. They're referred to as designated plans. The term individual pension plan was added, I think, in 2011. And it has to do with the funding model that the plan uses, which is the 7.5% rate of return, 5.5% wage growth assumed increase, 4% CPI. That is what a designated plan bases on. It's a 2% defined benefit pension plan. Overwhelmingly, like 99% of the IPPs that are registered with Canada Revenue are defined benefit plans. And I'm going to get into the brass tacks on that. There's about 15,000 of them. They're treaty friendly. RCAs are not. My basement is bedecked with Habs jerseys. I always love talking to Toronto fans because in Montreal, yes, we're not a very good team, but we've seen the Stanley Cup in color. And so I've done RCAs for the Habs, and my deal was I'll give it to you for half price. So I have 3 daughters, 9, 8, and 6. They simply refer to it as the team. They know there are other teams, and they know that Daddy has 2 favorite teams, Montreal and whoever plays the Leafs. And so there we go. That, along with other political reasons, may be why my wife dreads letters home from the teacher. So, what else? And the maximum funding, that's Regulation 8515. Don't go read this stuff. It's awful. There's a few papers that are out there on it. Leah Coive and I did one for STEP a number of years ago, and Leah updates it every year. So I can send over to Paul the most recent version of it. It is an insomnia cure of the first order. And because Leah's she's the accountant's accountant, like brass tacks. So when we present together, I tell jokes, offend half the room, and then she comes in and does the detail part. So who should be looking at these things? Incorporated professionals. So for me, when I was at GBL, everyone should have an IPP because that was what was for sale, right? Having been away from there since 2015, and I'm still friendly with all the actuaries, I'm a little more sanguine about it, and I look at it, if it's from a tax perspective, pure tax perspective, I'm going to tell you that most of the cases this gets considered, it doesn't really work because of the internal tax rate that the corporation is paying. But there are certain instances that are ideal for this. Incorporated professionals being one of them, particularly read doctors who can't save 10 cents. Because we all know, we probably all have clients, doctors get out of school in their mid-30s, the long-suffering spouse says, I need a 5,000 square foot house. Along comes the friendly banker with the here's your line of credit, and kaboom, guess what happens, right? So retirement's last on their concerns. Like I love running into the physician who's working at 85. I love medicine. Sure you do. Don't bullshit a bullshitter. So, owner-managed businesses is where this stuff really works. And the subset of that is getting ready to sell. So we have a case study on that. Family enterprises work with a big asterisk. Do not, as one firm does, run around and tell you to put your 18-year-old kid under a defined contribution on $100 a salary a year. Because if anyone has read the Canada Trust Co. versus the Queen case and understands the three-pronged test for GAR, that's that. We'll get into it. Personal Services Corps, they go after these guys a lot. They disallow most of the deductions except employment and retirement-related saving. IPP works very well because I think the effective tax rate for a Personal Services Corp is up north of 60%. So you want to have that as a remedy, if nothing else. There are tax planning considerations, obviously. For me, I really focus on transition. Either it's a family sale or to a third party, and we want to create a big deduction. So this is where it really shines. And then again, the determining factor for me is what's the tax rate the company's paying. If it is, are you paying GRIP or are paying paying 12.3? Because yeah, even though you get a bigger deduction anytime over really age 40 with an IPP, if you're only getting a 12.3% deduction rate, you're probably better off with an RSP at the same personal income levels. We also often look at our RCAs instead of IPPs in certain instances. And again, the RRSP could make sense because the IPP creates a full pension adjustment. You're going to lose all but $600 worth of room. So the RSP is not a bad thing. In many instances, I've recommended just keep that, look at something else. But it doesn't mean IPPs shouldn't be looked at. And what I like about them is it facilitates discussion. Because I'm a lawyer, I never want to be known as an insurance salesman. I am, in fact, an insurance salesman. I sell very, very large, intricate, split dollar par, crazy plate spinning, propeller head planning cases. But I rather have a conversation about planning. In an IPP, you rarely mention dying, which is a good thing. Whereas with insurance, the connotation is death. They look for your white shoes and want to know how much money you're making on comp, right? So it's never a nice conversation. Hence, I hand them a 15-page memo on why they should do certain things. I remember when I was working at GBL, Gordon, who is Scottish, and I still talk to him all the time. Gordon was the living embodiment of the golden rule that there are no Scottish diplomats. It's like if we really want things to go bad with Putin, we'll send a Scot to Moscow to try to negotiate that. But he used to always, because I would write things and he goes, goddamn lawyers charge for every word. Mm-hmm. We do. All right, so no pants, no. The key factors with the IPP are how do you fund it? There are 3 payments. 2 are deductible, 1 are not, or 1's not. The one that is not is the RSP rollover. So what you're doing, rather than go through all of the points, yes, it's age-based. The older you are, the less time there is to buy the benefit, hence the funding is larger. So what happens is that we come up with 3 numbers. What's your current service contribution, what's your annual contribution? Depends on the defined benefit calculation. It's a 2% formula. They work it back. I'll show you a slide as to what the numbers are. Then it's past service, and past service is a 2-pronged funding vehicle. In essence, they're saying, what would be the value of a pension plan had you already had it? Then they subtract the DC or money purchase version, which is the RSP. What's left over? That's deductible past service. It's the difference between RSP and defined benefit in layman's terms. The actuary will tell you, no, it's actually the combination of the accrued past pension adjustments over the period of time. That's correct. Works out to the same sort of thing. And the numbers can be quite persuasive. So this is just your current service. So this is based on this year's numbers. I would never set it up for a 45-year-old. I really don't start talking about them till they're in their 50s. Occasionally, we've talked to them in their 40s, and it's usually the doctor case. But in their 50s, you're getting a reasonable amount, I think. So instead of 29.2, you're getting 42.8 at 55. That's not bad. Again, depends. That difference It depends on what your deduction is, if it's going to make sense. And you get out to the later years, it's almost 50 grand. So that's great. Again, what's the effect of taxation? And then the past service numbers. And this is, again, at age 70 or age 65. And often you've got the spouse on the books, so you can double it up. And remember, it's based on index wages. So it's not a career average. So if you didn't make a ton of money in 1995, they index it up. That's why these things make sense for farmers. So I'm speaking at an agricultural conference in a couple of weeks. I'm not dressing like this. And when Yellowstone came out, I started buying Western clothes, and my wife says, "What's this stuff from Calgary?" I said, "I can wear this. I can carry this off." So, your numbers get pretty persuasive. So particularly, again, we'll look at the entrepreneur case. If they're in their mid-60s, they're getting ready to sell, even if it's transitioned to the hands of the kids, there's a big deduction coming. So we like that. Past service, you have to do, all contributions have to be done within 120 days of the corporate year end, so it's not 180 days like the bonus out rules. You can do lump sum, you can amortize it. You can't have savings twice, so that's why the qualifying transfer is in there. The 2011 budget changes, I'm not really going to touch on them in depth. Suffice to say, when it happened, we got together with a couple of the actuarial firms and it was the Martin government that brought it in, and were able to get in and see finance and wean them off what they had originally proposed, because they were basically going to get rid of past service. So what happens now is there's a double calculation that goes on, and your past service can be affected if you've got a mammoth RSP. If it's a couple, $3 million, yeah, your past service will get reduced. But the vast majority of people, particularly in these market conditions, don't. So it's something the actuary will run. And spousal RSPs do not work for the plan member. If the spouse is in the plan, you can use that as the qualifying transfer. So there's some things you'll catch from time to time. All right, terminal funding. What goes on here is this is the amount that you can put in at the end. Now the key is, what are you going to do with the pension when you reach 71 or you retire? And you must make a choice by 71. Are you going to continue the plan? Which in most cases now is what we advocate people to do. They can terminate them. I would assume now with the new inflationary numbers and interest rates, they will update the wind-up numbers. But wind-ups give rise to a taxable surplus, which can be pretty daunting. So a lot of the tax savings that were created can be lost if you unwind it. And if Leah were here, she would give you 10 minutes in depth on why you should buy annuities. Yeah, you should. I've never done them, but you can do a copycat annuity, basically roll it in. And in certain instances, that makes a lot of sense. I would say if the client has abundant wealth and they want the absolute certainty of that pension and they don't want to continue the plan, then annuitize it. And then a little trick that we use, something if you're dealing in the professional corporation market, the contributing employer rule. So we can't transfer plans anymore. And I remember when I was at GBL, we used to get people coming in saying, I'm working at Hydro, or I'm a fireman and I'm going to set up my own company and I want to roll my IPP over. Well, the government shut that down hard. There was a bunch of litigation on it. And I guess it was 2 budgets ago, they introduced changes. So it's virtually impossible to transfer a plan. But there are reasons that you're going to have multiple sponsors. So I'm going to skip ahead. It's in one of my slides, but I'll tell you why now. How many people deal with dental professional corporations? Okay, so DPCs are interesting because unlike an MPC, a DPC can sell. And there actually are entrepreneurs aggregating these things. I've done some work for them. So you have dentist who sets up an IPP, and along comes the sale. Well, what happens? The acquirer doesn't want to take over their pension plan. So what you want to do is you want to be out in front of this. Most dentists don't have holdcos per se because the college won't let them do it. They do what's called a midnight holdco. So they let the DPC registration expire on Friday or Thursday. They set up another corporation over the weekend, hook the two with a promissory note, and then reestablish the professional certification the following week. That gives you sister co. That gives you the ability to move the money back and forth. So what we end up doing with an IPP is the plan, and most of the funding is coming from the DPC. Sister Co is going to create notional employment, $3,000 a year, that kind of stuff. Then we're going to apply under the participating employer rule to add that Sister Co as a sponsor. You now have 2 plan sponsors. Under the current rules, or the past rules, and I'm pretty sure they still hold, DPC has to fund the promise that they made. So if there's a deficit or something like that, they top it up and then it falls off. You're left with Sister Co. sponsoring a plan. You want to continue employment, $3,000 a year for a while, and then if they take the pension or whatever, but you avoid the disposition, and that's completely on side. So that is what we recommend in most cases. It would work if you had OpCo selling, because these are set up in the employing corporations. You don't set them up in a holdco. The only time I've ever set up any structure remotely like that in a holdco was I set up an RCA for a holding investment company, where we created the employment relationship that the shareholder was the quote-unquote portfolio manager. So we actually issued a salary to them. We were able to deduct at 50.17 too, so there is that ability. So plan-to-plan transfers are basically out, but you want to have an eye towards what is their intention? Are they going to sell? Are they winding up? What's retirement look like? Okay, so case study one, and the key thing here is your numbers. You've got husband and wife, early 60s, looking to sell. They may have an offer, they may not. But we want to go and look at selling, and we want to first make sure we're going to be okay with QSBC. So this may fit into purification if they get too many passive assets. Because sometimes, as we all know, surprise, surprise, corporate structuring is rarely done properly. That's why they bring in guys and girls like us to fix things like that. But an IPP is a good way to help purify, because if we can get the deduction I'm showing you, it's on the bottom, I should have made it bigger. So this is husband and wife. We're getting them $70,000 of current service and roughly 1.2 in past service. So roughly $1.3 million of deduction. That'll purify or help. And that's a big deduction. You may decide, do it all at once, create a loss, go back, claim back GRIP from the last couple of years. So that can work too. And they got to roll over $500,000 of RSP. So that's a perfect IPP case from an accounting perspective, from a tax perspective. I prefer to do those because you're not, the tax works and the planning works. When you get the unity of both, then it's really good. With the doctors, it tends to be planning only, because who cares what their deduction rate is? They're blowing their brains out by spending too much money. So we're putting handcuffs on them. Okay, here's our physician. So this physician is, how old are we? 55. They've had their ProCorp for 10 years. They've used up they're always maxing their RSP. They have $500,000 worth, and taking T4. This does not work on partnership or dividend income. Simply doesn't. It's a full stop. So what do? We set up the plan this year. We get them funding of, let me look and see, $145,000 in total, and they have to move over $260,000 of RSP asset. So it's not a bad thing. You're getting them a good deduction. Maybe they bumped into GRIP that year, and that'll help haul it down. But this is more of a planning case. This is more of we want to make sure, Doc, that when you get out to retirement, if you truly want to, we've got something there for you. And there is that, let's face it, Canadians, or a good chunk of them, they all work for government, get a pension. Here's an ability for you to go out and create that foreseeable future for private sector enterprises. So I think it makes sense in that regard. We talked about this, again, pushing the creditor protection. Creditor protection gets oversold. People scaring people, properly structured. They're not, I mean, the doctors are extremely well defended and insured, probably the best of any profession. My profession encourages people to sue us. I don't know why. We're wonderful people, really, defenders of the truth and all of that. So I have to spend half a day tomorrow at I'm what's called a bencher of the Law Society, so that's the Board of Governors. And so tomorrow I'll be driving a pencil into my head like Trotsky while I sit through the lugubrious 4 hours. I mean, these folks send you emails that are 4 and 5 pages long, and I like to write. I'm long-winded, but ADHD is my complete character now. I just can't do it anymore. Lawyers hate me too. It's okay. My wife likes me sometimes. My kids like me. My oldest one finally, she was brilliant. She comes to us with a speech on the weekend about, she's 9, why she should have an allowance. So now I'm playing hardball. You remember? She gets $10 a week. She was like 5 a week or 5 a month. I surprised her. I said, "Go high." There you go. Okay, so this is what we get with our doc at the age 70. I should have put It's a herb. It's but 3.3 million. It's a big amount over the RSP, almost $1.5 million, and you're creating a pension of $271,000 a year. So that level of planning may push the tax considerations to the side. And again, it may not be that much income that you're doing massive tax planning. It also, because it will free up money inside the corp for other things. Hybrids. A hybrid is a plan that is both a defined benefit and a defined contribution, or it can be either or. I make reference to an article I was quoted in, a bunch of us were quoted in the Globe and Mail earlier this year discussing them. There is one company that markets it exclusively. I'm not going to talk about them. Basically, I describe the strategy as a solution looking for a problem. I did 2,200 IPPs at GBL in all provinces. We had never, in the 12 years I was there, recourse to have to adopt a defined contribution model in a plan. And also, previous to Mr. Ford coming into power, we had Section 48 of the Ontario Pension Benefits Act, which is also called the safety valve, which and the reason the hybrid ostensibly exists is because these are pension plans and you have to fund them. And under the old rules, ostensibly, not really, if you didn't fund it, there could be recourse against you to fund it. There still is, by the way, if you set these up for non-connected employees. Never set it up for a non-connected employee. That's Chrysler, General Motors. That's the problem, right? So this thing comes along and says, well, if you can't fund it, you flip to DC and you don't have to fund it. You always had the ability to make a written application under the Benefits Act to then Fisco to change your pension formula, and they always did it. So there was never a real need for it. And then fast forward, the Ford government gets in. The fellow who is then in charge of pension reform is now the Attorney General, and representations are made to him by KLU, by a number of accounting organizations, by me over a whole bunch of beer at the Royal Canadian Military Institute one afternoon. And lo and behold, a pension reform comes in. And so what you need to know is that under the new current rules in this province and virtually all of the other provinces, we have adopted a Quebec model, which is if you are the shareholder, the connected person, and you set up one of these plans, you can elect to not be bound by the Ontario Pension Benefits Act, which means you don't have to fund the plan. So the purveyors of hybrid plans are looking for new reasons for you to buy their structure, and it is very much a sale. It is not a consulting approach. And so what we find, in my humble opinion, are some pretty egregious reasons to do it. One is the family business. So the family business case goes like this. Mom and dad, and I've set up a few family plans. So the first one I ever did was in the first years I was at GBL. It was for a family that owned a successful automobile dealership in Southwest Ontario. Mom, dad, 3 sons. We put them all in the plan. Sons were all in their 40s, mom and dad were in their 60s. We all funded on defined benefit. The plan's funded. Mom and dad retired, draw their pension, pass away. Well, because junior, and junior are in the plan, there is no deemed disposition. So it made complete sense. But the key was the planning worked because junior, and junior were absolutely employees of the company, as in this was their life. This wasn't $100 of notional salary. So that is what gets sold. And then they'll tell you, well, the same no disposition works. Well, I'll also tell you as a lawyer that family law is a very large concern, and half of the marriages in Canada end in divorce. And if your spouse that you're divorcing, even though we're only getting paid $100 a year to be in this family pension plan, that's an asset that's clearly tied to them. Any enterprising family lawyer is going to go after that. So avoid it. I think the logic that they're pushing is, as I said in the article, pure sophistry. So look for the reason. Why do you want to do it in the first place? The other arguments they make are, well, we have a pension lawyer. We can provide pension law. Again, I'm a lawyer, but in the 2,200 plans that we did at GBL, never, ever did we have recourse to have to go to a pension lawyer. If it's the Bell Canada pension plan, yes.
So Trevor, question about that last comment where you said in the event of divorce, so you're suggesting that would have the entire contents of the...
They're going to go after it, as much of it as possible.
Right.
And Paul, you know they're not going to get it all.
No, that's,
But you're going to incur lots of fees to do it. Right? So it's common sense. Do what's in the best interest of the client. What's the client's retirement look like? What's their level of sophistication? How aggressive are they in tax planning? Because again, go to the Canada Trust Co case. It's 3-prong test on GAR. That fulfills it. Retirement compensation arrangements. So I still use RCAs. RCAs are really simple. They are special purpose trusts identified in the Act that are not bound by the 21-year disposition rule. They are used in a variety of situations. They are the only means by which you can fund corporately on a deductible basis excess retirement benefits. Canada has, comparative to our other G7 partners, very low pension limits. We can create defined benefit plans in the US and in Europe probably 2 to 3 times bigger than what we can in Canada. So previous to the RCA rules, there were a number of structures that were short-lived but set up to try to fund, usually around using defined or deferred annuities. So you're the president of XYZ Corp, the board comes and says, we want you to be happy, and the pension can pay you 40 grand a year. So we're going to buy an annuity that's going to kick in when you retire, and if you shuffle off the mortal coil, your spouse will get it, and we're going to deduct the cost of that now. And everyone was happy except our friends at Revenue Canada, who came along with a big stick and said, okay, we're going to go after all of these things. We're going to use the RCA deeming rules. And they still do. It's still a big stick. So you want to make sure you're never deemed an RCA, but you may want to create one. And so what happens is a trust is created, registered with a special division of CRA, very simple vehicles. The documents are not inordinately complex. It's a standard trust. If there's an ancillary document, what we call a supplemental executive retirement plan, that's a whole other ball of wax. Most of the time in the owner-manager world, you don't want that document because you want as much discretion and flexibility to go to the employer. And if you turn around and say to your general manager, I'm paying you this into an RCA along a certain funding formula, guess what? They're going to act on it, right? So I'm one of these lawyers who says less paper is better. So the RCA still works. And it's why we like it. It has to do with flexibility. There is no age limit on it. Well, 18 and up. I wonder if you can go less, because I've had cases where we've talked to like kids who do apps and stuff like that, and YouTube influencers that they're 16 years old. So we looked at that. I'm like a LinkedIn influencer. There's no money in it apparently. I'm still trying to figure out how. Just get put in the penalty box. I can tell you what I called him, but not in the main body of the conversation. We can do that after. So what I like about it, again, is the flexibility. You have an age thing, no age 71. So I had a case in New Brunswick a zillion years ago where we had a guy, he's dead now, he was 85, and he was selling to his company to Junior and his Junior's buddy. And because it was not arm's length, no one's getting the lifetime capital gains exemption. So what we ended up doing was doing about a $7 million RCA out for Dad. Junior went in the plan, and we depressed the book value of the company so that we could effectively reduce the capital gains tax. You use it to get recapture back. So there's a lot of pure accounting reasons RCAs work. They have to be reasonable. Reasonable means an actuary has to certify. It has to be based in pension logic. So what we usually do is a 2% benefit formula based on their real earnings. So if they make $2 million a year, 2% of that times years of service. The structure itself opens a custodial account. It will also open a refundable tax account. So if you put $1 million in, $500,000 is invested, half is retained by the government. They pay no interest on it. Any realized investment event, whether it's a gain or loss, will result in remittance to or return back from the refundable tax account. And when you want to take money out, it's optional. It's loss of office. So there's no age limit. A loss of office is death, disability, retirement. A lot of what we'll do for planning purposes is they go to dividends at a certain point, and so they technically are not employed. And so they start taking money out that way, and they can take it out in whatever amount they want. So you can structure it. You can do some income splitting. It's complex, so usually what happens is we simply put the spouse in anyways, and that tends to work. And when you take it out, if you took out $100, $50 comes back to the trust custodial account from the refundable tax account, not to the plan member themselves. Why? I used to do a lot of them for bonus down, but be aware of salary deferral. Now, this was a government shakedown of the first order, and Gordon, the belligerent Scot, and I wanted to actually find a test case because we knew that what CRA was doing. And anyone ever heard of a front-end leveraged RCA? So this was something a very talented group of brilliant accountants and insurance minds, and they're still around today, devised. And it was a means by which you could take an RCA, and because the refundable tax account was a receivable of the trust, and trusts are allowed to hypothecate the assets, you would enter into a financing agreement where you would borrow back 90% of the trust and refundable tax assets and finance your company. Beautiful stuff. Gordon and I used to do them, or we would build them and charge a whole $6,000 to build an RCA, and now we look at each other and go, we were idiots because we could have made millions of bucks because it's all insurance. Needless to say, in 2012, that was the reason that they changed the RCA rules and brought in Advantage, prohibited investment, and all those rules. So those are there now. In terms of investing in an RCA, as long as the investments is arm's length, you're fine. Yes, you can use insurance. Just be careful that there are more pitfalls associated with that. I do a number of files where it's insured RCAs. We're generally using what's called a split dollar agreement, where the insurance is held outside of the trust and the cash value is the asset. Again, that's inside baseball stuff, but we can talk about it. Anyone leaving the country, that's the big one. Often it's foreign execs. They're here for a 3-year contract, use an RCA. Athletes. I've done tons of NHL work, as I told you, lots of Habs stuff. I've done one Leaf, a couple of Canucks, a couple out in Alberta. I don't ask them for their jerseys. The NBA I've been to the altar 4 times. Every several years, an advisor goes, I know this player. And I say, well, I can dust my memo off. They're going to say no. And they do. So Major League Baseball does it. They do it through an outfit in the U.S. I've never been able to crack it. I think soccer does. CFL, let's face it, winning the Grey Cup gets you a quarter chicken dinner at Swiss Chalet. So, and I am a season's ticket holder for the Hamilton Tiger Cats. That's some interesting demographics. So. How not to build a football stadium? It's always.
By the way, how can the NBA say no?
They say it's an unfair advantage to the Raptors because I could turn a Raptor into basically a U.S. taxpayer. Be careful when dealing with U.S. citizens. They work, but you have to do some extra work. The Americans do not recognize RCAs as they do pensions. So RCA contributions are fully counted as taxable U.S. income. They will create offsetting foreign tax credits, so there's an equilibrium point you have to find. So usually I retain an accountant who understands this, has cross-border experience, and giving me a number, and they sign the wonderful letter. But you can do them. The other reasons is a young person who's making a ton of money. So let's say you got a software guy or something like that, and they're making millions of bucks a year, and think, well, maybe IPP. Well, the IPP numbers aren't great. And so you do an RCA, let them fund their RSP. We put a reversionary clause into the RCA so that if they turn around one day and want to set up an IPP, I can drag it back through the company and do it. The other thing, a little secret of the temple, is for non-shareholder employees, you do contributory plans. So let's say you've got someone integral into the operation and they don't want to give that person shares, but they want them to be taken care of. So they set up an RCA and they put a clause in it, or we do, saying the person can or must make a personal contribution to the plan. They can match. They can't exceed the company contribution, but they can match it, and that's a personal deduction. It's like a big RSP contribution. So that can work pretty well too. It's not considered a corporate asset. It's a trust. So it's good for purification. It's great for tax reduction. So a lot of what I'm doing right now in pre-departure planning, without giving away all the secrets, we use something called non-exempt insurance, and we buttress that with an RCA. So when they leave, they're paying Part 13 tax on the RCA amount, and I'm not going to tell you how non-exempt works, right? Well, I can, but it depresses corporate values. I think we covered that off. I'm running ahead of my slides. U.S. person. Insurance, don't try to use PAR. You can. Universal life works much better. Understand that the biggest issue with insurance is time. It doesn't work unless you have the time to fund it. And unfortunately, what happens, there's a couple of folks in the industry who really understand this very well. There's an outfit called RCF, Roy Craik. Roy is in his 80s. really decent guy. Strictly speaking, was a big competitor of mine. Roy knows his stuff. He understands how to use insurance. I do too. But really, you have to identify a planning need, because insurance works because it's exempt and is not subject to accrual taxation. That's great, but you better need the insurance. And usually we do that when we're talking about setting up postmortem planning. So we need to create CDA to do either spousal will and redeem or in 164.6s. So my forte is something called hybrid pipelines with insurance shares. I'll put that kind of stuff, planning into that. And again, we almost always use shared ownership or split dollar agreements certified by an actuary so that we're not running into CRA issues. What else? Oh, we have to talk insurance. Put white shoes on now. Freedom 55 was the strategy developed in 1981 when interest rates were 19%. And the idea was really simple. You put, I guess it was 20% of your salary into a London Life policy at that point, and in 20 years you had so much cash value, you marched it down to the bank. They give you a line of credit, and there's your retirement. And your death pays the loan off. That works, still works, even in this interest rate. In fact, it works excellent in this interest rate environment because the dividend yields on policies are increasing. Most of them, the par policies, half of them are in government bonds, so they're in the midst of frantically turning their bond portfolios over into. And I'm not a bond guy, but into bond portfolios with 10-year maturities at 4 and 5%. So that will preserve a pickup in the dividend yield on a policy longer that hopefully interest rates remain high. So it works. And the difference here is that it's done corporately. So I like these for doctors because it inculcates savings. Most of the insurance people, like the senior marketing or field reps, will tell you most people never pull the trigger on the strategy. They fund the policies, they get all kinds of cash value, and then they don't use it. That's good. It means they didn't need to. But in essence, the strategy is you identify from the doctor's saving ability how much can you earmark to a policy. You build the policy with additional deposit, so you're maximizing cash value, and routinely we're getting 80%, 85% cash value to dividend in the first year. That grows. They fund 10 years, 20 years, whatever they want to. They get out to retirement, and then they have a choice. They march the policy down to the bank. The bank either lends to the company, they pay the loan to the company, they pay a taxable dividend. The reason you do that is you have RDTOH balances. Or the more likely is they don't have RDTOH balances. They do shareholder borrowing with a guaranteed agreement. They take the loan personally, their death pays the loan off. You have to be careful about how you structure it. The banks help. You don't want to create specified rights and all that kind of stuff, but that's all in the weeds that we deal with. But that works. And in many cases, I like that more than an IPP, because if they are saving enough to do that, it assumes they maxed their RSP too, and they got a better tax result with that. And this helps with purification. Well, it's not considered a passive asset, so it doesn't help with purification, but the doctor's not going to sell their MPC. But it does creditor proof it, so it can work pretty well. That's everything. Ask away. I'll take any questions. And I'm not allowed to run for office. I've been told 3 times.
What's the difference between the IPPs and PCPs?
Me PPP? That's what I was speaking of. The hybrid. That's what the hybrid is. Yeah, it is an IPP that has a trademarked name, which is PPP. It is an IPP. It is not anything else.
So,
Let me just fill up my water here.
I guess to Trevor's point, and I concur with them, the PPP has lots of bells and whistles that'll never be used.
I have a good friend who refers to it, and he says it's like buying rust proofing in a dealership. I didn't say that. So, but it is an IPP. It's 8515, governed by the same regulations. It just has a trademark name. It's like I could create one called the Farmer's Pension Plan. There's no section of the Act creating the Farmer's Pension Plan. It's an individual pension plan.
I was just saying there's a lot of fluff on it, I guess that's what you're saying.
In the words of Sir Francis Urquhart, you might say that, but I couldn't possibly comment. Anyone ever see The Real House of Cards? Not that thing the Americans did? watch it. It's a BBC show. If you have BritBox, it's on there. The first 2 seasons are fantastic. The guy who plays King Charles, because they assume that happens, is flawless. So if you want good viewing, watch The Real House of Cards.
I've had a couple of IPPs in my practice, but in both cases, and I was assuming this was the normal case, it was where there was a big spike in earnings.
Yeah.
There was a sale of a business, or they won the lottery that year, and they weren't expecting it to ever happen again.
Sure.
Is that still a principle used for?
You have to continue to be able to fund it. So assuming you made all your past service contributions and you have enough earnings to continue your current service, then sure. But how much of it, again, if it drove them into grip from small business, would they be better off with an RCA, which could be funded once, right? So I'm not saying it's not a good idea. It's totally dependent on the planning needs that client has.
But, so you're saying that if there's a one-off thing, an RCA might be more appropriate?
Yeah, because you can single fund an RCA. An IPP, you have to fund it for a while.
What if they just quit and just take the buffers forward?
They could, and under the new rules, they wouldn't have to fund it, but then you're going to have disposition of the plan. At some point, what are you going to do? And if you don't want to carry the plan, then it's very likely you're going to kick out a taxable surplus and give back all the tax savings that you created on day one. So I'd prefer, like IPPs work where you want a pension. If you want a tax result but flexibility, it's probably not the avenue that I would go down.
I have a situation, I'm not sure it's, Trevor, you're the one to respond, if you need somebody to
If it requires diplomacy, no, but go ahead.
2 corporate clients with gobs of money.
Yep.
One has a bank-owned brokerage
Yep.
that's offering them financial services and financial planning, estate planning supposedly. The other guy's a doctor whose money is split between a bank and MD Management. Neither one.
MD Management is a bank now, by the way.
That's true, yes, Scotiabank. Neither one, to my knowledge, has been advised by their advisors that an IPP might be appropriate. I really think it is in both situations. How do I redirect them when they've already got people looking after them?
Ostensibly looking after them. Yeah, I would have the conversation about it. All of the banks will have some sort of an IPP arrangement. A lot of them, I mean, when we were at GBL, we were very big with BMO in particular, TD, it's some CIBC. Buck is in the banks in a big way. They tend to be top down. They're not really boots on the ground, but they have a good product. LMC is in it, some of them. So they do have the ability to access IPP. And it just simply may be, like many accountants, they've never seen one before. So unless the advisor dismisses it out of hand, which I would be more concerned with, you could ask them, hey, listen, do some research for me. The other thing with MD is MD, and I did a lot of work at MD. The first major marketing deal I ever did at GBL was with MD. And they are the firm that should have 5,000 IPPs. I'd be surprised if they have 200. Now, previous to the Scotia acquisition, they used to self-decapitate every half a year. There was always someone new, right? And they would spend money on this software project and that project, and they would spin wheels. And their whole raison d'etre was, well, Doc, you're a member, so we're giving you a little bit, preferential pricing on mediocre return. So I don't buy that. Return is return. Canada is, it's a tight market. Paul can tell you there's a way to differentiate. You want hands-on, you want responsiveness. If the advisor's not giving them that, you give them a chance, but if they fail, you have recourse right there. I mean, Paul knows as much about IPPs as I do. I met him when I was at GBL, right? So, and my meter does not go on. If you call me and say, what do you think about this? What's a 20 or 30 minute conversation? Because we might unearth something else, right? For instance, that's why I said IPPs they're nice ways to start conversations because you don't have to talk about dying. I sell a lot of insurance because of IPPs. And again, I don't the negative connotation of sell, but in certain instances, it really works quite well. But I would just raise it with them because all of the bank firms have relationships. None of them have IPPs per se, but they all have a relationship with an actuarial firm or firms.
So Trevor, one of the things that I think is often not spoken about is being able to pass along the plan intact to another member, legitimately if they're working there. And to me, that's a big deal as compared to an RSP or a ref, where half of it's going to literally be taxed in the year of death. Is that not a common?
Well, it's a conversation, Paul, that we always have with somebody, because I like to start, you start from a comprehensive planning perspective, which is, yes, I can solve your tax problem today, but what's your tax problem going to be there's a life cycle to a business. So most of my memos follow along that model, saying, okay, at one point there's the transition stage, sell, wind up. What does that look like? Then the dying stage, where I get into hybrid pipeline talk. They have to understand all that stuff. And the IPP has to fit into that too. So if they're simply looking for a big one-time tax savings and they don't really care what the back end looks like, it's not the right structure. If it's a true family business, you can add someone as a member in 24 hours. You can do it once mom and dad are on their deathbed if you have to. So it is flexible in that regard, but it's got to be solidly grounded in what is the future view for that company, that enterprise, that professional corp.